So good afternoon, everyone. It is August Thursday, and I looked at my calendar the other day and realized that in 1 month, not only was I going to finish the summer semester, but I was ready to start the fall semester. So a very unusual 2020 and a very fast-moving 2020 right now. And obviously, with all the things that we've experienced as in the globe, in the country, and in the real estate industry and in the NYU community, we've been doing these webinars. And the idea with this one was to look at the structured finance that is a big part of the capital markets, real estate financing sector, and just step back and look at how the structures are working in the face of all of this strange market activity that we're in the middle of. And I have invited two professionals who I know for a very long time and who I thought would bring a great view from both the pricing risk of a global investment bank and a major law firm who's also in the trenches as opposed to the tranches, dealing with all of the issues that we're facing in the market. So today I'll make the introductions of our two guest speakers, talk a little bit about some of the numbers and the structures and documentation, and then it'll be a very informal discussion, because I think there's a lot of things that would bring out as opposed to just having you look at PowerPoints, because I'm sure this semester you're probably tired of doing that anyway. So on that note, I'll introduce our two guest speakers. Dan Huffenus is a managing partner with Katten, a major law firm, and he's out of the Charlotte office and is part of the national real estate practice. And I've had the opportunity to work with Dan over the years. He's very active in CMBS and very knowledgeable about the securitizations market, origination, servicing, and defeasing CMBS loans. And Tom Doherty, who's a managing director with Wells Fargo Securities in New York. Tom and I had the privilege of working with Tom at Bear Stearns back in the late 90s, early 2000s. And Tom and I, so we had a chance to work together, and Tom brings the perspective of how deals are getting priced right now, because Tom's the guy that the originator goes to and says, here's my loan, I want to do this one, what is it going to cost? So on that note, just a couple of quick points. This is not like the prior ones. I mean, we all know that. We've been at home, people are not traveling, you're working from home. Only essential businesses are open, although more have opened now, it's still minimized. And then e-commerce is really the way that most people are shopping right now. I had heard a statistic that in the last 3 months, we've moved forward in terms of the curve of where e-commerce was heading by 10 years. And I don't know how you measure that, but it's a pretty interesting perspective. And it just feels like there's pretty much nothing that I'm not ordering online right now. It's about masks and hand sanitizers. I think we got the toilet paper part under control. And then in some markets, the numbers are getting worse again. So this was literally this morning from Green Street, looking at the commercial property index. We see the decline that occurred as of the end of the first quarter of this year. So going from an index for all property types across the country of 135.4, with 100 being the peak of the market, and then going down to 120. So a 15-point drop in the overall index across the country. That is not, of course, consistent for every asset type. So when you look at the individual sectors, you see everything that's below this 100 line is where we've still seen a drop off of the prior peak, right, of 100. But you see several of them that have gone up and haven't come down that much. others that really started the decline a lot earlier. So the dark blue here, malls, that started its drop in valuation back in early 2016. Hotels were kind of flat, and then we saw the significant drop recently. So the numbers are really showing the impact. But the other interesting thing about it is showing that it's not just as a result of COVID. There were property sectors that were already starting to show some signs of softening. As far as the delinquency and late payment data, these were pulled from TREP as of yesterday. They reflect, for the most part, the July numbers, but in some cases, especially for the single asset, single borrower deals, that's the SASB universe, those are the large transactions where the predominant collateral is either one building or one portfolio cross-collateralized. And those might have some newer numbers, but for the most part, we see just under 10% of the outstanding conduit multi-borrower balance being either 30 days delinquent or longer. And when you add in the ones that are in the grace period or less than 1 month late, it takes the number up to 50 billion, 50.7 billion. On the single asset, single borrower side, we're talking about $12.6 billion that are delinquent 30 days or greater, and another approximately 4 billion that are either in the grace period, not yet late, or less than 1 month. I took another cut of the data just focusing on retail and hospitality in the single borrower sectors, because those seem to be the ones that are really driving some of the problems. Excuse me. And in terms of retail, pre-COVID, because there really haven't been a lot of single borrower transactions that have securitized post-COVID, you have 12 loans representing $4.2 billion, or 18% of the outstanding single borrower market that are retail market that are delinquent. And then on the hospitality side, you have 7.7 billion, or 21.4% of the total that are delinquent. So those are pretty big numbers. Those clearly are the sectors that have gotten hit very hard. And just a quick look back, this is April. In April, we were 42.7 billion, or 11% non-current, and only 2.8% delinquent, that $10 billion number. So we could see that $10 billion number went up to $38 billion. So we've seen a significant move in that delinquency number. So I will now stop my share, and maybe Tom and Dan, I'm sure that I know that I haven't completely spoken about your exquisite roles in the industry and background. So maybe if you could take a minute or two each and just tell everyone a little bit more about yourselves, and then we can start talking about what's happening in the marketplace.
Tom, you want to go first?
Yep, go ahead, Dan.
Okay. All
I'll
right.
let you go first.
Sure. So I'm Dan Huffenus. As Tino mentioned, the managing partner of the Charlotte office for Katten Muchin. Been in Charlotte for 27 years or so. Started practice in New York at Strickland Levan many years ago. I did a lot of CMBS with Bear Stearns even back in those days. Going further back, I also have a master's in real estate development from that other school up in Morningside Heights from the late 80s. But I did have the good sense to come back to NYU and get my law degree there. So big fan of the institution. But I've been a real estate lawyer now for over 30 years, doing primarily lending work, although I do a decent amount on the borrower side. I've got a pretty diverse practice. Once upon a time, it was almost all CMBS. It's probably now a quarter to 30% of my personal practice is CMBS. Represent lenders in a lot of different food groups, sort of debt funds, life companies, pension funds, and commercial banks as well. And I also do some servicing and a little bit of special servicing. And like I said, some work on the borrower side. So I've had a little bit of experience dealing with some of these COVID issues from the other side of the table. So I think that's me in a nutshell. Tom, you're up.
I'm Tom Doherty. I hold a engineering degree from George Washington University and an MBA from the far north part of Manhattan at Columbia. I started my career at Lehman Brothers in residential mortgages in 1991. So I've been at Lehman, JP Morgan, Bear Stearns, JP Morgan, Wells Fargo. So I've lived through a whole bunch of cycles from the market's perspective, everything from the 96 mortgage blow up, the 98 blow up, the 2001 situation, 2008, to 2012, to this. And this is kind of a unique experience, but they all have themes to them, and we can get into that as we talk through this. My primary role at Wells Fargo is pricing and hedging our CMBS book. So that has been a challenge, to put it mildly, in 2020, probably as bad as it was back in 2007, 2008, when I was at Bear, and as challenging as we've restarted the business as it was in 2012 when we restarted it at JP Morgan, just in terms of trying to figure out how do we bring together borrowers and bond buyers that want exposure to real estate, but what structures are we using now, because it's different than what we used 2-3 months ago. And it's the same thing that we went through in 2010, except that the delay was actually longer. This time things have moved back to new lending fairly quickly. In 2008, 2009, there was very little CMBS really in 2009, and then 2010 you started it up again. Here, we had a lull really from, let's call it April when you stopped, and then you're starting to restart now. And we did a couple of deals already in July. We're going to be in the market with a large office building deal in New York City, concurrent now. So things have come back fairly quickly. Some of the structures for new issue have modified, and really where most people got caught is in that transition between something that was started pre-COVID, may have closed pre-COVID, and then what do you do with the stuff that didn't get sold before everything ended, and what are you creating with the new stuff? So it's definitely a challenging environment. And I think for real estate, there's an additional part of, there's certain sectors that are doing well, and there's certain sectors that are in severe distress and have a lot of unknowns as to how they're going to play out, combined with sectors that look okay right now that are starting to get questions about what their viability or what they're going to look like in, with this work from home being more accepted by institutions.
Thanks, Tom and Dan. I'll immediately go off script for a second, because I thought that in listening to the backgrounds and the fact that all of us have kind of ridden the roller coaster up and down several times, right? You always know it's not going to be like last time, right? Whatever it is, something's going to be different, and you try to structure as much as you can from the lessons learned of last time, so that next time you kind of have that potential issue boxed, and then a whole other set of things happen. So, I mean, just maybe, Dan, what's your experience been, just because of the time you've been in the industry, the things that have always seemed to work, regardless of the cycle, the parts of these structures that just always hold firm, what are some examples of that versus the surprises that we think we have covered and we don't?
If I just look at the last two sort of major crises, if you will, back in the 07, 08 timeframe and today, 07, 08, I think we could all agree that underwriting had gotten fairly frothy. That was really the problem, or a big problem. I don't think I ever saw a 10-year IO deal before 2005, and then between 2005 and 7, I think the word amortization disappeared from term sheets, and LTVs got pushed pretty hard, and underwritten cash flows started to include tenants who signed LOIs, and it got to be fairly frothy, right? And so that was a big problem. A lot of those deals just blew up. And when CMBS 2.0 launched, I mean, there was a real focus on sort of getting our act together. Let's underwrite cleanly and consistently, And I think the industry has done a really good job doing that. So, but here we are today, and it's like the underwriting's fine. And that's not been the issue. It's just this, when tenants can't open and then they can't pay rent, it just, so this has been one where, I don't know that we could have predicted or sort of planned for this type of thing. We are starting to see some more structure around COVID-related issues. First of all, to the one of the comments I started to make earlier, certain property types, hotels and retail are just really, really hard to finance. Just almost impossible right now to finance because I don't know how you underwrite it. You don't know when you can expect a normalized cash flow. So those type, those property types are kind of dead in the water. But with respect to, self-storage, multifamily, underwriters, can figure out the markets and understand the asset and start to put together good underwriting. And I think we're seeing a lot of lenders require things like debt service reserves up front, maybe a 3 to 6 month debt service reserve, just because you don't know what's going to happen over the next 3 to 6 months. And so, that's one sort of structural thing. Will that be a component of term sheets that lasts beyond COVID? My sense is probably not. Once this issue is behind us, that probably drops off as well. But and probably should, get back to sort of some normalized occupancy that we can all understand. But right now, that's something that we are seeing in different term sheets. There hasn't been a whole lot of different structuring. Pricing has gotten, a little more lender friendly. I think, spreads have gone up a bit. And so, and leverage down. And so I think the underwriting has gotten even more conservative, and that's appropriate. But structurally, no, there hasn't been that much that has changed, other than, like I said, the debt service reserves as a result of what we have going on right now.
So at some point, Tom, you'll get the originator that'll come down and mention another lender and saying they're not requiring debt service reserves, so we need to do that to win the deal. It's just going to get whittled away. You quickly get to the lowest common denominator. I think, the B buyers will help give some discipline to it. But one thing that did come out from COVID is this concept of springing, sweeps, springing reserves, and trying to do everything sort of let it build up over time. When you have an economy stop, there's no cash flow to build up. So kind of need the cash to be sitting there. And in the restructuring and work, one of the reasons why the charts aren't as bad as they could be is that people have been willing to use, PIPs, use TILC reserves, et cetera, to fund debt service to carry from, where we are now to when you expect the economy to reopen more generally and you start to receive rental payments. I think that's been especially true in the hotel sector and in the retail sector, but you had to have those reserves there in order to do that. If there was no reserves, then there's no cash to pay your debt service, and there's no rent coming in. So it's one structural thing that maybe we put back in, but like you said, it generally get pretty quickly whittled away. Yeah, and Dan, when you bring up the idea of the reserve kind of building up and having something up front right now, when you have some of these loans that have 2 and 3 and 4 times debt service coverage because of low interest rates, from a risk perspective, that doesn't sound like that unreasonable an ask. Maybe not write the check for a year's debt service on day one, but the idea of a little sweep that accumulates, so you have several months sitting there, it's yours, it's for debt service, but this is in the event that you can't open your building, and at least you can keep paying the debt service for a little while. So it doesn't sound bad, but it's something that I'm sure, like Tom said, it'll get whittled away when competition is back and people are trying to do deals, and the only way you win it is to give something up. So, Dan, when we chatted the other day, you talked a little bit about some of the features that were in place at the loan level, at the loan agreement level, that have been working as planned, And obviously, I'm not talking about just like the mortgage security, but just some of the other things that have been working. And you said that you've had some pretty good, uh, successes where everything has kind of worked the way it should, even in the face of this unusual time. So maybe you could talk about like what an example might look like or something like that where it worked.
Yeah, I mean, look, I think the docs all work just fine. It's when you have to. We're trying to get creative now to figure things out when maybe the economics aren't working just fine. And sort of like we're talking about the structure on the front end on new deals. And I think Tom, you alluded to this. Certainly in the first round of borrower requests for some sort of relief related to COVID, to the extent there's money sitting in buckets. Lenders have been generally pretty flexible in allowing access to those buckets. PIP in a hotel that's going to be shut down for the next 6 months, or very, very underutilized over the next 6 months. You probably don't have a big need for CapEx, and so they've been allowing some sort of access to those funds to cover debt service, and taxes and things like that. With the idea though that that's got to be replenished over time. So we've been modifying deals to do that. Now Corey, what happens if this thing doesn't get better fairly soon, and it comes time to start refilling those buckets, and there's no money to do it. I mean that's we haven't entered that phase, but I think that's right around the corner, and that's going to be somewhat challenging. I worked on a deal, and one I alluded to when we talked, Tino, for a major national retailer in their headquarters building. So an office product, an office building, but for a retailer that's particularly hit hard in the COVID crisis. And so I represent the owner of the building. So not the retailer, but the owner of the building. And the retailer, who's 800-pound gorilla, basically sent a letter, said, we've been really hit hard. We're not paying you rent on our headquarters for the next 2 months. And we cut a deal with them, and where they would get a couple months of deferment and then pay it back over a 12-month period, and then we went to the servicer. It's a CMBS. It's a pretty big securitized loan. Went to the servicer with that approach, and they were, again, this is going back to probably April, May, when we had the first discussion, and they were quite amenable to having that discussion and willing to do it. And then, of course, given the CMBS structure, it's got to go to the special, and falls into a bit of a black hole. But eventually, we got an approval letter out, and 2 months later, and the loan, for reasons unrelated to COVID, had been in a cash sweep, a ratings downgrade issued. So there was a big bucket of cash sitting there. And so the structure worked, right? The CMBS structure worked. There was money sitting there available. They were able to redirect it. Bondholders got their monthly check, and now the retailer's back, and paying rent and paying the additional 1/12 of the deferral, and we're replenishing that bucket. So that was a situation where I thought the players all worked well together, and the system and the structure worked, and we got where we needed to be. There have been a lot of initial requests that came out of this from borrowers that said, we've got these problems. Sort of two types of requests. One, we've got issues on cash flow, and then secondly, a different bucket of requests looking for approval on PPP loans, which were, in theory, these are don't have to be repaid if you check all the boxes and use the money right. But it's additional debt, right? It's additional debt in the name of the borrower, and that's a problem on an SPE structure for a CMBS loan, or for frankly any other lender that requires that kind of structure. And so, they were probably less. Lenders have been less willing to do that, certainly in the CMBS context. And the whole notion of additional debt, even though in theory it's debt that'll be forgiven, it's not absolutely required that it be forgiven. And so there's been some reticence on the part of servicers to do that, and I think far fewer of those requests have been granted than people might have anticipated. And on initial requests for forbearance too, I think there's that there were a lot of lenders, a lot of borrowers, I think, that probably took an opportunistic approach and said, this is a national pandemic, we don't have to pay our mortgage, and national pandemic or not, you're an owner of real estate, you hold the equity. This is an equity risk before it's a debt risk, and so you need to you need to stroke a check if you need to keep things going. And if you're not telling me you can't stroke a check, I want to see a whole bunch of financial information and things like that to support your claim. And at that point, a lot of those requests went away. And borrowers, and where they saw light at the end of the tunnel or felt good about their assets, stepped up and wrote checks if need be. So there were probably fewer forbearances, certainly in the CMBS context, than I think people may have anticipated. But it's going to be interesting now. I mean, again, we're entering, I think, sort of the second phase of this. For the first couple of months where there were forbearances or other accommodations given the borrowers, there was an expectation that 3, 4, or 5 months from now you're gonna be able to start making us whole again, and that may or may not be the case. And so it will be interesting to see. I mean, the servicers have a difficult job, right? I mean, their job is to make decisions that maximize the value for the bondholders, as a whole, and that's a difficult standard. And so again, you're going to start having discussions about where's the line between what's the equity risk and the debt risk, and yeah, we want to play nice, but servicers have a fiduciary obligation to the bondholders. I mean, they have to make decisions that do the most to ensure that the bondholders get the benefit of their bargain, get that monthly coupon. So it's going to be an interesting next phase. And I think we're just now starting to turn that corner, and we'll see where it goes.
So Tom, you're sitting in the lender's seat, and there might be loans that you have on your books now that you've priced that might be that it had a spot to be sold, and then it didn't quite make it to the closing before everything hit in the market.
Right.
So,
I mean, what we've been, what we've been seeing is, on the forbearance side, you try to cooperate, but you also try to get something to help on that side. There's a couple ways to get something back. One is, a simple way is more frequent reporting, especially on hotels where you're looking almost week by week as to what the occupancy and RevPAR are. We've also seen, asks for, we asked for a little bit of a pay down just to reduce the leverage if it's possible, but they may not have the cash. And then the other one, to make it saleable, is really to try to build up some sort of debt service reserve that's maybe 6 or 12 months. If you can get that, then generally the liquidity for that loan comes back a little bit. Because the feeling, and it's going to depend on the property itself, right? There are some hotels in this country that are doing fine because they're, it's staycation time. People are driving to them. They, I have a house in the upstate New York in the Adirondacks, and all the cabin hotels where you just pull in, they're like efficiency places, they're packed because they're socially distanced. And then the ones that you see are having problems are like the big group hotels with lots of food and beverage, et cetera. They're going to be a different story. But, anything that people could drive to, maybe you start seeing cash flow. And we're starting to see that on some of the loans in the portfolio, that the cash flow is starting to come back in parts of the country because people are, you can't stay in your house all day long. You'll drive yourself crazy. So they're going somewhere. And the same is true for some of the retail, because if you're a grocer or a drugstore, then you've gotten some sales going. And then the draw of those grocers and drugstores, once the nail salons and everything else started to open, you could get there. So, the ones that we haven't been able to distribute yet are really limited. And, we've sold hotels into securitizations in the last month or so with the structure where you have the reserve, but also a hotel that has a reason not to rely on air travel or big group business, because I think that's going to take a while to come back. And as far as like sort of one of the things with the structure what Dan was mentioning, the bonds that most people hold at the senior part of the capital structure are at significant premiums. They don't own them at par because the market has rallied from like 130, 135 on 10-year treasuries to 50 basis points. And while spreads have widened out, the tightest they were this year was 70 or so. They went out to like, call it 300 or 200, and then they came all the way back in to around 100 on high quality stuff. So it's kind of different than what it was in 2008, where people were worried about extending the bonds as they came due because they owned them at discounts. Now you almost want people to take the cash and don't pay me down if you're a bondholder, but just put it in reserve and continue to make your payments. because you don't, if you're the first class in the structure and you own it at 103, the last thing you want is getting back a payoff at par, because they probably will negotiate away the yield maintenance or defeasance. And I think if for those of us that remember the GGP bankruptcy, the only thing that really came out of that bankruptcy was a cram down on the prepayment penalties that GGP was due to pay that they got out from underneath on the bankruptcy. So there's some precedent that if they go too far with the borrowers, they can get out from some of the prepayment penalties. So it's kind of an interesting dynamic. A lot on the bond side depends what's your basis in the bond, and do you feel like you're at risk of losing principal? The structures played out very well up through triple Bs the last time, so I don't think people expect to lose money. It's just the timing of the payment may make a big difference if you own it at 85 cents or if you own it at 105.
Is there a difference in the perception from the investors that are on the buy side, like buying your securities, about retail, hotel? What percentage is kind of a cap that they're willing to see in the deal?
Yeah, I mean, even before, retail was kind of capped somewhere around 15 to 20%. Hotels were in the same neighborhood. The fear pre-COVID was that we had built too many hotel rooms in this country, and specifically in parts of the country like New York City. And then retail, was a slow burning, like slow train coming at you, especially on regional malls and any of the mall product. This episode showed that there were risks to sort of smaller retail centers that didn't have an essential business in them. So there's lots of concern as to how much retail is in the deal, what's the percentage of what's the percentage of hotels and retail. And what people are starting to question is, what do you do with office if this continues and you have a trend for work from home that gets more expanded across the United States and more accepted in more industries, where what's the demand for office space? And I've heard all sorts of different arguments that you want the Class A stuff, the best, the newest, and the other one is you want the Class B or C stuff, like the garment center stuff, because you can re-tenant that much quicker than you can re-tenant large floor plates. So I think there's a lot of sort of market discovery that's going to have to come through. And the interesting thing for CMBS is, given the programs from the Fed in the corporates, and even though they didn't include new issue CMBS and TALF, it is a legacy issue. Legacy issues are included in TALF, so it's kept us from having spreads blow out. And with where coupons are, borrowers are borrowing, call it, low 3 handles, sometimes inside 3. So you've got a very low rate environment, even though the challenge is really on the top line cash flow and what that's going to look like. That's the underwriting right now is extremely difficult on almost any product, unless it's an Amazon lease.
Yeah. The segmentation part, just in looking at the post and pre deals and looking at the percentage, some of them we saw 30-40% combined retail hotel, and now you're seeing combined 10 retail, 0 hotel, or maybe no more than 15. So it'll be interesting to see if there are other asset types as we go forward where the market says, I don't want to see more than 20% of that, or I want 50% industrial. That I like.
Yeah.
Often not so much.
Yeah, I think what unfortunately will happen is some bond buyers will come up with percentages that don't actually add up to 100. So, which is a problem.
So,
an interesting asset class, an interesting property type that we were just talking about internally here the other day is the flex office type stuff, the WeWork model, that kind of the short-term office rental, that had seemed sort of in the light in the wake of everything that's going on with WeWorks become a very unfavored asset class. But as office now, to your point, no one really knows what that's going to look like, and that may be a sector of the office market that winds up getting some legs. So I've heard some internal discussion about whether that should be treated more favorably than maybe it was even just 3 months ago.
The interesting thing, Dan, with that product type, a lot of it is, I guess, well, the biggest tenant in Manhattan was the work, the co-working tenant. But there's definitely some momentum toward the burbs, where if I don't have to take public transportation, then I can drive to a hub of my company. So those could change. That's more the mix and maybe the momentum of activity, but it still affects the structure of the deals, and just the cost of operating, right?
Yeah.
The work might work well, but it can't be the sardine can model,
right?
Until we're way past that concern, right?
Yeah.
So Tom, you have talked about actually writing some, starting to write some new deals now, and Dan, you're representing borrowers or lenders on that. Are there any loan features that clearly are coming out of kind of post-COVID, trying to maybe fill a gap or capture something which was really more interpretation and not explicit?
I wouldn't say from my perspective interpretation or not explicit. I think what the springing reserves structurally are kind of really difficult because no one expected things to just be binary. This was an event that basically just everybody closed down at the same time. The expectation always was that you'd have the sliding scale, right? So if one tenant or your debt service went below a certain number, then you'd start to build up the reserve, but you still had time to build up the reserve. So that conceptually is something that's getting, discussed. We've been trying to put in a debt service reserve, and we're hearing from B buyers that cash is king versus any sort of hard lock box or soft lock box or springing or anything else. But from most borrowers, it's an additional equity cost to have cash put up front, right? So it affects their returns. So they're always reluctant to do it or trying to minimize it. And then, we've also seen people try to come up with a structure where it would get released if COVID goes away. And, then you get into the legal definition. What does that mean? So, it's a lot of this caught people off guard, and people are just working through it. And then the other issue is everything really, if you think about it, has to work with how the lease works. So is retail going to go to percentage leases? Is it going to be a fixed lease with like a pickup if you do very well in that retail location? So that's the question. There's a lot more scrutiny now on any office buildings where there's give back of space, because the expectation is that probability is higher than it was pre-COVID because of what we talked about on office. And then on industrial, the questions are who's using it and what's the use for it, right? Before it's just industrial, and you're seeing a little bit more question as to whether or not that's the last mile, or is that a little further out where it doesn't have quite the same value that the last mile would have, And then the question I've heard from people is, well, if the last mile is to a city that's shrinking, that doesn't help either. So I think there's an awful lot of uncertainty until we get to the other side of this, but there's also a lot of creativity because at the end of the day, people still transact. There's loans that still need to be made. There's plenty of equity money available for real estate and other assets. You can see it in the equity markets right now. So, people want to put money to work, and the borrowers and the lenders need to figure out a way to make it work both for them and then for us as a lender to make it work for the capital markets, because the bond buyers are looking for more and more paper. And we can thank the Fed for taking a decent amount of corporate paper out of the market and a substantial amount of residential mortgage and treasuries out of the market. So investors are having to search for products. So, that's something that I think came out of 2008, 2009 with the Fed programs. And that was one of the successes, I think, this time around. It wasn't perfect, but it certainly definitely helped the liquidity of the securities and therefore the demand side for us to make loans.
Tom, a point that you just made that I think is worth maybe a little bit of discussion is that the general liquidity on the equity side. I mean, there is a lot of dry powder, if you will. and that's been talked about for a while. And what role is that going to play as we enter the sort of next phase, right? I mean, I think there's some proposed legislation to have some government-backed pref equity investment in CRE, which I think doesn't have a very strong chance of seeing the light of day, but nonetheless, it's out there and people are thinking about those things. But whether or not you have a government backing, I think the role that preferred equity investments may play going forward is kind of interesting. I do think that there is dry powder and there is going to be opportunity for folks that have cash to come in and take a position in some of these deals that sort of buoy them, that doesn't have to come at at a cost to the bondholders. But it's still got to work its way through the system. It's additional debt. You need servicer involvement and approval and analysis and all that kind of stuff. But I think that's an untapped or at least underutilized resource at this point that may be valuable as we enter the sort of next COVID phase.
I mean, it's interesting. You hear a lot about dry powder for, rescue capital.
Yeah.
Right. And, the question is just the way the market might be willing to be, modify prepayment penalties just to allow things to survive. Are there potential places in the structure where the borrower bringing in someone with cash and saying, look, if I don't have this money, this is going down and fast. This is going to allow me to execute on this plan. Here's the plan.
Mm-hmm.
Like, give me permission to bring this other capital partner in there. And let's figure out what the right way of doing that is.
Yeah. Because
otherwise the story's not going to end well.
Right.
So, Dan, you also, we've spoken a lot about the CMBS market. You're also doing work on the balance sheet side with construction and also with just balance sheet lenders. And that's obviously a significant part of the outstanding debt as well. Are there any differences how those loans are being structured now versus pre-COVID that are different than CMBS loans?
That's a good question. I mean, a lot of the stuff that I'm doing that's sort of non-CM isn't your sort of 10-year fixed rate stuff. It's floater construction or bridge with a heavy construction component. Again, more reserves, little money cash up front for debt service and things like that. But a construction loan, you're funding that stuff anyway. But just lower leverage, perhaps. So I don't know that I've seen a time. We spent a lot of time talking about force majeure and what that means, and how does this play into it, which has been kind of an interesting conversation, and varies by market. Markets where you've got labor supply that's shut down in but construction has generally been considered an essential business, and so in most cases that hasn't been a problem. But again, a lot of discussion about delays and force majeure and how a pandemic fits into that. So that's been I don't know that I can. It's not really comparable to CMBS, but that's certainly been something that we've been discussing a lot on those deals.
Okay. As we look at new deals going forward, the uncertainty still remains, right? You can listen to a webinar on Monday that talks about V, and we're going to be back before you know it, and nothing's going to be different by the time we get past this, to the Great Depression 2020 and every version in between. With that uncertainty, it seems like trying to structure things as best as you can, whether it be at the lease level or at the loan level, continue to just kind of morph. And I'm just wondering, even on the borrower side for operating a building, if you have to put in all of these capital items to make it healthier air, touch-free, and all the other, maybe you look at the bathroom door and it opens by itself so you don't have to touch the door, whatever they're coming up with, who pays for that? And is that starting to make its way into the structure vis-a-vis the lease and maybe ultimately the loan agreement? Because that could be pretty pricey. I was just wondering if you've seen that coming up yet.
You know, that really is interesting. I mean, I had not thought about that, but yeah, things like, you know, little kick openers for the doors and whatnot. I mean, there is stuff that's going to require some retrofitting. You know, whether it's driven by tenants, in which case, to me, that's more of an underwriting issue than a loan agreement issue. But to the extent that it's mandated by the government, right? If you have to, in order to have a CO or be in compliance with local ordinances or building codes, that you have to put some of that stuff in. Yeah, that'll be interesting to see how that works out. I mean, clearly you have to comply with it. So yeah, that's a really good point. And how that'll undoubtedly come into play in the loan docs.
And you know, Tom, even on the underwriting side, when you think about the cost associated with some of these things, who's going to? Like, it's too early to figure out who's going to pay. If your cleaning costs go up by 150, 200%, 300%, because now you have more people doing it more frequently with more expensive products, and someone's got to pay for that, and the tenant is saying, you know, that's not, you know, that increase over base year is not what I signed up for.
It's not. Yeah, I mean, I think you'll have fights over the CAM and everything else. And then the other thing that's, I think, still has to be worked out is any liability issues that come up from the use of the building, and, you know, who's responsible for if somebody gets sick or a group of people get sick. You know, you mentioned the HVACs, and, you know, that's whose responsibility is that, right? Is it the building? Is it the tenants? You know, and how do you prove that it came from the air and everything else? And I also think that, you know, the government has a role in terms of setting out some protection around liability in an environment where people don't know, and it's not something that they directly created the underlying issue of, but the legislation hasn't come through. And, you know, it'll be interesting to see how that all plays out over the next, you know, 3, 6, 9 months. You know, I mean, just look at what's going on with schools, right? I mean, it's not dissimilar than bringing an office building back. You know, what do you do with a trading desk? What do you do with, you know, an open floor plan? You know, where you have offices for, you know, partners, and you have, you know, cubes or something else for associates. How does that work? And then who gets to work from home and who doesn't? You know, there's lots of liability questions and issues that have to get sorted out. You know, and then what do leases look like when they roll? Right? I mean, do you have to modify them to deal with this and everything else? There's, you know, a lot of questions. And then, you know, where do people want to work? How do you get to work? You know, there's a lot of uncertainty in the world. And, you know, I think until we have some sort of viable treatment or, you know, a well-sprung vaccine, and we treat this as if it's just flu season each year, and, you know, you got to be careful. You know, that's going to all have to get worked out. And some property types, you know, self-storage is not really an issue, right? Hotel, a massive issue. Office buildings, it's a question mark. And then retail, isn't that the retail center is no good. It's just, do people want to go out and shop, you know? You know, I think it'll be interesting to see what Disney does with Mulan and how well that works, because the Troll movie, which I don't understand, but it did great. And, you know, if that's a delivery mechanism that impacts, you know, the movie theaters, or maybe it forces the movie theaters to make themselves bigger entertainment centers, you know. So there's a lot of questions in the real estate market right now. I think those are questions. And then the flip side is there's an awful lot of capital available to address the issues and to try to get us from point A to point B at the moment. And I think one thing on the borrower side is, you know, you talked about the preferred equity. I think the reason it's available, it's just a question of cost, and can you afford the cost, you know, or do you wind up losing most of your equity value anyway, and you just say, you know, here's the keys. But we're going to have to go through all that, and, you know, hopefully there'll be enough actors inside the CMBS structure that behave appropriately, that allow solutions to come to fruition, you know, and we'll see. You know, I think the standalone single borrower deals will be a good test first, because that's where most of the large hotels were done, and then the conduit ones will deal with the smaller ones as we go through it. But, you know, it's all happening live. I mean, you know, a lot of the retail that was done post the GGP bankruptcy. So that's going to start coming due in 2021 and 2012. So it's right around the corner.
Yeah. One of the issues, I was going to say, just one of the issues is this, you know, sort of inherent in the CMBS structure, and it's been sort of the Achilles heel of the industry, in my opinion, for many years now, is the servicers and their ability to respond and react accordingly and appropriately in a timely manner to move things forward. And you know, I'm sure in an environment where we had crazy low default rates up until March, you know, sort of pre-COVID, and the industry was humming, you know, they're sort of staffed at a level that supports that kind of an environment. And now all of a sudden you switch on a dime to an environment where, you know, you have borrowers flooding them with requests for relief, and that's, you know, there's no end in sight for that. You know, the system is stressed right now. It's undoubtedly stressed. And again, from my experience with that retail headquarters building that I worked on, I mean, the actual line master servicer was responsive and quick and terrific, but, you know, then it has to kicked up the chain to the special for approval for a significant mod like that. And it's, you know, it's a black hole. And, you know, that's not necessarily a, you know, criticism of the players in the market. I think it's just that people are understaffed right now to deal with those kind of things. And so there's a little stress on the system that I think is going to be problematic in the short term.
Yeah, it wasn't quite a ramp up that we got. It was more
Right.
like hit the hyperdrive button.
Yeah.
And we just go up. So
Yeah.
there were there's a few minutes left. There were two questions that we got. One, I think both of them. One of them is pretty nuancy. So what I'd ask you to do, the one who asked about the accounting question in physical life, to follow up with me, and I'll do my best to get you a really good answer on that one. The other question about 1031 exchanges and what happens, the potential of it disappearing. I think that's going to be a political hot potato that's going to have to be dealt with through the rest of the year and into next. But my personal opinion is changing 1031 or eliminating it could have a significant impact on valuations in the market, because a lot of people rely on that tax deferral for the price that they pay. So
yeah, even if there's a political appetite to do something like that, given all the other body blows that the real estate market's taken these days, my sense is that gets kicked down the road. I would be really surprised if that were to happen. But, you know, you made a point. We're overlaying all of this stuff. You know, we're heading into a very significant election, right? And so, you know, talk about unpredictability. My goodness, and there's just so many variables right now, and that's one I'm not, you know, I'm not going to touch that hot potato. But that could go so many different ways, and how all that affects the government's role in this turnaround is going to be just incredibly interesting.
Yeah, I normally say,
I mean, I think
like
the Fed is the one fixing that.
Yeah.
Yeah.
It's the Fed.
So, they
turn the spigot on, and that's helped smooth out a lot of stuff.
Yeah, no doubt.
The printing press is always a good tool.
Yeah.
Yeah.
So the other question I'll get to, like I said, reach out to me. But any other questions from the participants, from those listening in, that we can maybe answer? We have a couple of minutes left. So don't see anything else. So I just I guess one more question. The rest of this year is going to have this continued uncertainty, and I think part of the question is going to be, what are these assets going to be worth? So how is that value concept being handled now, whether it be from the the underwriting side, how are you looking at valuation? Because that's going to drive special servicing, appraisal reduction. There's still a whole bunch of places that the structure is there that we haven't pushed against it yet because it's early. You know, one of them is appraisals and appraisal reductions, and whether you start reducing the bondholders based on appraisals. So, any view on that? As
I mean, if you think about the valuation issue is a top line. You know, it's the numerators. What is the cash flow off the property? With rates where they are and where coupons where they are, cap rates should be stable, if not lower. You know, if you look at what it's going to cost you to borrow plus a return, you're not at 6-7% cap rates. So that's not going to be the valuation issue. It's what is the cash flow, and that I think is going to get down to almost like a property by property. What's its use? What's the sponsor look like? That's going to matter a lot. The more deep pocketed sponsor can afford to do it, but you know, one thing we struggle with always is, as deep pocket as a sponsor is, most sponsors are serially correlated. They own real estate. You know, there's a handful of large owners of real estate that own other assets, generally tech tycoons. But for the most part, if you own something, you own other somethings of the same thing. You know, you own a bunch of hotels, you own a bunch of office buildings, you know, except for the private equity funds. So, you know, the sponsorship can get stressed over time because all its issues are generally all its ownership interests are generally in similar asset types. So it's not a diversified ownership. So it'll be interesting to see. But I think the valuation issue is really just what's that top line look like? What's the numerator?
And this is just purely anecdotal, but the things that I've heard that the way that servicers have been treating a lot of these requests have been treating them in a way that doesn't trigger any kind of an appraisal or an appraisal reduction, because it's just, you know, right now appraisals are it's very hard to appraise anything right now. So sort of avoiding that potentially disastrous outcome.
And that could go both ways. It could be disaster, like it's too high.
Yeah.
Right.
Yeah. Right.
Or it's too low. I mean, it's too unknown. So why, you know, it's almost like you don't want to ask the question without having some idea of what the answer is going to be.
Right. Exactly.
And I don't know who knows what that idea is right now either.
All right.
So, gentlemen, thank you both very much for the insight, for the transparency, and for joining us today. Maybe we look at the end of the year and say, okay, now all these other things that we didn't test yet, we'll see how they're holding up too, right? Like pari passu loans, risk retention, operating advisors. Is that stuff that was put in place that hasn't been beaten yet? How are they holding up after we get to them too? So Tom, Dan, thank you very much. Thank you everyone for participating. Feel free to email any questions, and this will be available for you. And have a great rest of the week and weekend. And for the students, enjoy the rest of the semester and good luck.